Hey guys, welcome back to Stacking Stocks, and thank you so much for tuning in today. We've got some exciting stuff for you today. We'll have an extensive assessment of NIO stock. So let's hit the ground running. It's easy to sour on equities like NIO. The so-called Tesla of China shot up more than 3,000% between March 2020 and January of this year. Investors were no doubt dreaming of mammoth gains in 2021 with a growth curve that would make them feel like Elon Musk. Well, that hasn't happened. NIO stock has fallen more than 40% from its high and is currently trading below $40. Production problems have plagued plenty of electric vehicle companies thanks to the global shortage of semiconductor chips. There's also global shipping delays and, of course, continued tension between China and the West, particularly the U.S. If you bought NIO stock at the beginning of the year, you're sitting on a 19% loss heading into the final month of 2021. We can't really say that there's much good news from the third quarter numbers. So is it time to cut your losses and cash out? Or is now the time to double down and grab some more NIO stock at a discounted price? It's nice to think that the world may be emerging from the coronavirus pandemic, although we wouldn't bet against another wave this winter. But even so, there are signs that our economic troubles aren't in the rearview mirror yet. China was the epicenter of the pandemic, and its economy was the first to be affected. Therefore, it was also the first to show signs of recovery. In fact, China has proven to be an effective bellwether for economic difficulties since COVID-19 because the trends there are running a few months ahead of the U.S. Therefore, it's concerning that China's gross domestic product growth slowed substantially in the third quarter. Beijing says China's economy grew 4.9% in the third quarter after registering 7.9% growth in the second quarter. The numbers could indicate more economic problems in the fourth quarter, including possible stagflation. If this comes to pass, it's hard to imagine it wouldn't have an impact on Chinese companies like NIO. But that's a bridge we're yet to cross. So what makes NIO a differential in the EV manufacturing industry? The thing that really makes NIO stand out is its battery swapping service. Instead of having electric vehicles plug in to recharge, NIO's battery as a service strategy allows drivers to simply pull into a battery swapping station and exchange a depleted battery for a fully charged one in less than 5 minutes. NIO has more than 500 battery swapping stations in China and plans to install its first soon in Norway, where the company just expanded. In October, NIO reported that it had completed more than 4 million battery swaps since the first station was opened in 2018. The company said it plans to be operating 700 battery swapping stations by the end of the year and 4,000 by the end of 2025. That's an amazing feat. At least we're witnessing some massive progress with the EV-making giant. The BaaS program is a huge selling point for NIO. The company says it makes the cost of an electric car $10,000 cheaper. Beijing also is generous with subsidies for NIO because of its battery swapping service. NIO is the clear leader in BaaS technology for now, but we expect the competition will be more intense in the future. In the meantime, NIO is ramping up the production of its EVs. On October 1st, the company announced that it delivered 10,628 vehicles in September, representing a 125.7% year-over-year increase. In total, the company has delivered 142,036 vehicles as of September 30th. Now, looking closer to October 22nd, NIO ended at $38.88. There was a huge open and a run-up on October 25th on significant volume, closing the stock at $41.27, followed by 2 consecutive days of sales pressure back below $39.31. The pattern is interesting because a technical trader would say it tested the $40 level but couldn't hold, so they would predict the stock would fall much lower and it would continue to break down. However, that trader would be wrong. The stock again closed on October 28th above $40 per share, tricking investors into a potential leg higher. Now, the stock has for the third time closed below $40 per share, and aside from looking at the tricky technical chart, which, by the way, when we connect the 3 bottoms, still points to an uptrend, we want to discuss some very important numbers we received about October deliveries and why we're seeing this uncertainty in NIO stock right now. We're going to have some thoughts on where NIO stock is headed next. NIO had a remarkable run-up of over 2,000% in the second half of 2020. This massive surge occurred around the same time that Tesla and other EV-related stocks took off. Since the substantial run-up, we've seen some volatility. However, the stock has mostly stayed in a consolidation pattern for nearly a year now. We believe that this phenomenon is pretty odd and mismatches the fundamentals as NIO continues to ramp up production and increase sales. We suspect we can see more consolidation around here, but the stock should break out and look substantially higher as NIO will likely continue to expand operations and grow sales considerably in the future years. So why has NIO been on a downward trajectory? One reason why NIO dropped below $40 per share again is October deliveries. NIO delivered 3,667 vehicles in October 2021. That's down 27.5% year over year. The vehicle deliveries in October were significantly impacted by the reduction in production volumes as a result of the reconstructing and upgrades of manufacturing lines and the preparation of new products introduced from September 28th to October 15th, as well as certain supply chain volatilities. So, honestly speaking, the numbers are surprising because we were expecting to see delivery figures well over the 4,000s. However, given some additional thoughts and given the situation in regards to the supply chain issues, we can't be very critical as we believe this is going to be a short-term bump when you zoom out a year or two from today. Despite the production and supply chain challenges, the company's new orders reached another all-time high in October, driven by increasing user demand. What does NIO's stock long-term potential look like? We see a lot of positive catalysts coming for NIO stock. Due to the restructuring and upgrade scheduling, ES8 production was resumed towards the end of October. The deliveries in October consisted of 218 ES8 vehicles. That's the company's 6-seater or 7-seater flagship premium smart electric SUV, 2,528 ES6 vehicles. That's the company's 5-seater high-performance premium smart electric SUV, and 921 EC6 vehicles, the company's 5-seater premium smart electric coupe SUV. As of October 31st, 2021, cumulative deliveries of the ES8, ES6, and EC6 reached 145,703 vehicles. We're expecting November, December, and January deliveries to pick up significantly. You see, EVs are the future of China's auto landscape. Not only is NIO in a growth market, but the Chinese government is going to favor an in-house EV manufacturer and support them. Obviously, Tesla has been a core holding of many and recently surpassed a $1 trillion valuation. But we think that NIO is still very much underappreciated. Some investors may be discouraged by stock that had such a remarkable surge in 2020, but had recently stalled and just not given us the expected returns. Some market participants may even think that NIO is in a bubble still. They may say NIO has an extremely high valuation. It's just hype, or it's just completely overvalued, and so on. But nobody knows exactly what will happen or what investors should expect. No one knows at the end of the day, but before you make any decisions that may prevent you from making money in the future, here's a brief outlook of the actual facts and what's likely to happen going forward with NIO stock. Investors in NIO stock should have a long-term outlook. Just make sure that you're happy with how the company is ramping up production. As long as NIO is a leader in BaaS technology, it's an appealing way to invest in EVs. Also, NIO is relatively new to the market, and the company only began officially making deliveries in late 2018. In addition, 2019 was a year of limited sales as the company had just started manufacturing, and then the COVID pandemic just hit, and NIO was in a very tough position at a very tough time. But despite all this, NIO has been able to achieve something that no one expected. There is so much potential that investors should be looking forward to concerning NIO. Let us know your thoughts in the comments section. Don't forget to like, share, and subscribe. See you next time right here on Stacking Stocks.